On this episode, we're going to revisit an investment strategy that has not worked for the past 10 years. You may be thinking, why would I do that to you? As of this recording, the international markets are finally starting to show some outperformance. To allocate to the international markets, you need a plan. The legendary Gary Antonacci is going to give you his time-tested strategy. Today, we're revisiting in a podcast I had with him 4 years ago. Gary is the author of the seminal book, Dual Momentum Investing. Gary came on and he shared his knowledge of quantitative investing that combines both trend following with relative strength. This is a methodology backed by decades of academic research and real-world application that I think could apply going forward. We're rebroadcasting this episode because the core principles of momentum investing are timeless. As Gary explains, the idea that past performance can indicate future short-term performance has been observed for nearly a century. Despite evolving markets and new investment trends, the human behaviors and market dynamics driving momentum always endure. In this interview, Gary traces his history of momentum, from its early discoveries to its recognition as a powerful factor around risk-adjusted returns. He then clearly outlines his dual momentum approach, which integrates absolute momentum to assess overall market trends with relative momentum. This is a rules-based systematic method, so you know I'm a big fan of it. Whether you're a seasoned advisor who has a system or you're just beginning, understanding these principles of momentum investing could help you if you're starting to leg into the international markets. I hope you enjoyed this interview. The first 15 or 20 seconds with Gary, his audio is a little bit off, but it corrects very quickly. Thanks for tuning into this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me for this episode is Gary Antonacci, who is the author of my new favorite book, Dual Momentum Investing. As listeners know, I've been going on this quest the past several months to get a deeper understanding of trend following and the quantitative side of our industry, having spent 25 years as a fundamentalist. If anybody else is considering on going down that journey, I recommend starting with this book. Gary's been kind enough to come on the podcast and share his thoughts. If you are a long-time student of momentum or trend following, this particular episode may seem a little bit more basic because we're going to start from the bottom up. Gary, thank you so much for coming on the podcast.
My pleasure, Jay. Glad to be here.
All right, so you have a very distinguished 40-year career in this industry. After receiving your MBA from Harvard University, this is really all you've done. So your ability to distinguish between or to implement academic research in your own research gives the information that you present in your book to me a high level of credibility because the concept of momentum goes back over 200 years. Could we start from the very beginning with momentum and walk us through the history of momentum?
Well, the first actual study of it was in 1937 by Cowles and Jones, a couple of economists. And what they did was they tracked the performance of every New York Stock Exchange stock from 1920 through 1935.
Hey, Gary, if I could stop you for a second, we're having a hard time hearing you. Is the headphones that you had plugged in? I bet they had the microphone.
Um,
Oh, we got you now.
okay, can you hear me all right?
That's a lot better.
Okay, I'll just sit a little closer here. So Cowles and Jones were two economists in the 1930s who studied every New York Stock Exchange stock from 1920 through 1935. And what they discovered was that stocks that had performed well the preceding 12 months tended to continue to perform well going forward in time. And people didn't pay much attention to it back then because uh, there wasn't really much quantitative investing being done. And then after that, the efficient market hypothesis kind of took over finance when it became more quantitative. So it wasn't until the 1970s that people picked up on momentum again. There was a study by Jagadish and Pittman in 1990, in which they basically validated Powell's and Jones' work, uh, showing that stocks that had performed well over the preceding 3, 6, and 12 months continued to perform well going forward in time. So momentum is actually persistence and performance. It's actually the strongest factor out there in terms of risk-adjusted returns.
And based on my reading of your book and other research, it's the strongest factor out there, but wasn't that debated for a long period of time?
Well, factors in general have never been fully accepted. There's still a lot of people who are into a buy and hold approach or a fundamental type approach to the markets. But factors have been gaining some prevalence over the last 5 or 10 years. And in fact, there's more factor investing going on now than there ever has been. Momentum tends to be, uh, as I mentioned, the one that has the best returns. Value is one that's been known about longer, and that's still more popular. But momentum is the one that fits into the realm of trend following and technical analysis, as well as people who want to apply a more fundamental approach.
So, as when the folks out of the University of Chicago were putting forth their work and presenting it not only in academic circles, but then it was used in application in the investment world, and it worked. And then there was a history of the intersection of that and the momentum factor in their work. Would you mind explaining a little bit about how all of that played itself out?
Well, that's kind of interesting. There have always been some issues having to do with the capital asset pricing model and the idea of efficient markets. Back in the 1970s, when I was getting involved in the investment field, uh, people were very keen on the efficient market hypothesis in the academic world, and everything was in terms of beta, just a single factor beta. And that evolved over time as they saw some of the limitations of the efficient market approach. One thing they noticed was that low beta, low volatility stocks tended to do better than they were predicted to do. And so people started coming up with other ways of looking at things by incorporating other things into the model. At first, they had extra market covariances, and that evolved into more formal factors. Value and size were the first two that were seized upon back in the 60s and 70s. And then momentum, as I mentioned, didn't really gain any prominence until the 1990s. But it's it has a lot more flexibility because you can do more with momentum. You can apply it to different things other than just stocks, and it's held up in all kinds of academic research. More academic research over the past 20, 25 years has probably been done on momentum than any other factor.
So, all the models that I have built up until till this point have all been based upon valuation metrics. In fact, the person who turned me on to your book, a gentleman named Clint Sorensen from Wealth Shield, I told him I wanted to go deeper on momentum and trend following. This was the first book he recommended, and going through it, I started to understand the construct of how they're building portfolios and applying momentum, how advisors could do it when they're building portfolios for their clients, but a lot of times explaining that to the advisor and the benefit and the applications of it tends to be the biggest challenge. So, what do you say to folks who've spent their whole career, like myself, over 20 years focused on valuations to start using more of a momentum overlay and lens when building portfolios?
Well, they should probably go back to the literature. Like I say, there's been a lot of academic work done in momentum since Jagadish and Titman in 1990, 1993. There's been all kinds of papers looking at momentum as applied to individual stocks, all different other types of markets, and looking at momentum in the two ways that it can be used, both uh, on a cross-sectional or relative basis, where you're comparing one asset to another, and on a time series or absolute basis, where you look at it as a form of trend following. Uh, and what I did, I think my contribution to the field is combining the two together into what I call dual momentum, where we first ascertain whether stocks are going up or down, and based on absolute momentum. Give you an example. Uh, if the S&P 500 index, for, let's say, has gone up over the past 6 or 12 months, you would say it has positive absolute momentum. And since momentum is persistence in performance, it should continue to go up until that changes. So once I determine whether the trend is up or down in stocks, then I apply relative momentum to ascertain where I should invest in the stock universe. And research has shown, Geske and Semenov has a great paper on that, where they compared asset relative momentum applied to different assets, looking at commodities, currencies, fixed income, uh, equities, and country indices. And they found that momentum works best when applied to broad country indices. And so that's the way I use it. I separate my investment between US stocks and non US stocks, and I'll invest in whichever of those two shows the highest relative strength over the given look back periods that I use.
So, what I found the most helpful in your work is that while you have an academic lens on everything, you write in a way that somebody who's a non academic, you don't need a PhD in finance to understand this dual momentum model. So at its core, you have the relative momentum to determine whether you need to be in the markets or not. In your example, you're using the S&P 500. You just mentioned a 6-month or 12-month look back. If I recall in the book, it's pretty explicit about it being a 12-month look back. Is my memory correct?
Yes, but let me just say that it's absolute momentum that you look at first to determine trend, and then relative momentum to decide where you want to be in that asset class once you determine the trend. 12 months is the most common one that's used in the research. It's held up really well. It's been taken all the way back to the beginning of the stock markets in the 1600s, and with other markets all the way back to the 1200s. And it's held up uh, as something that offers advantages over buy and hold in all these different markets during this entire time period.
Yeah. So you can see how new I am to this. I already got the decision tree backwards on that. So we're starting with absolute which way it's going. Your models are showing we start with the 12-month look back on that. And then you're looking at relative between the US or an index of securities that are outside of the US. Now, correct.
Yes, that's how I use it. Uh, and then the momentum can be applied to the fixed income market as well. I do that with some of my proprietary models. Momentum works just as well applied to the bond markets, but with different parameters than you would use it as applied to the equity markets.
So because that's part of your IP, without getting into the details of what that would look like, are you just taking a couple of different subsets of the ag and determining where there is relative value? Should you choose to, if the absolute momentum tells you you need to be in fixed income?
That's correct. Basically, we're looking at intermediate or short-term fixed income, and it can range the whole quality spectrum as well, from high yield to short-term treasury bills.
Okay. Excellent. So, listeners and viewers, if you go to optimalmomentum.com/FAQ, there facts FAQ, there is every question that I could dream of to ask him about it answered for you on there. We can only answer a couple here, but the first one that came to my mind as I was reading it is what about other sectors being added to your global model, such as not even sectors? What if you just wanted to add gold if gold was only trending in a nut model?
Well, momentum works with everything, so it's just a question of portfolio construct from that point on. I prefer to rely on equities because over the long term, it's had the highest risk premium. You know what you're getting there. Gold is more of a alternative. It can be used in a minor way in any portfolio. It would benefit from the application of momentum, just like most every other asset. But I focus on the equity and bond markets because equities are where you want to be in as long as you can be in them. You know, as long as their trend is positive, that's where you're going to get the highest expected long-term return. And the best time to be in bonds is when equities are going down, because then there's a shift of assets away from stocks into bonds. And there's usually a recession, and the Federal Reserve wants to keep interest rates low, during recession. So that's positive for the bond market as well.
So the proof is always in the results. For video viewers, I'm going to put up a chart that shows the long-term performance of the GEM portfolio. Tell me, Gary, high level, what's driving this specifically?
It's market, basically. The stock market is, like I mentioned, is where you want to be in. So about 50% of the time, the blue line that you see there, global equities momentum, is in the S&P 500 index. About 30% of the time, it's in the ag bond index. And the rest of the time, it's in the MSCI All Country World Index. That's what the global asset benchmark is below. That's an allocation to those three indices in those percentages that I just mentioned, without the application of momentum, switching from one index to another.
And so this particular performance set, looking back, has a monthly rebalance. Is that correct?
That's correct. Every month we take a look and look at our windows for rebalancing, and then see if we need to make any adjustment. There's not that many adjustments that need to be made. This GEM portfolio has about 1.3 switches per year.
Very, very tax efficient.
Right.
All right. So here's some rolling return. Here's some rolling return data on that same GEM portfolio. Listeners, viewers, you can find this on the website, and I will have links to this in the show notes. Gary, tell us, what are we looking at?
Well, this is a histogram view of rolling 12-month return for the GEM index versus the global asset allocation benchmark that I mentioned. And you can see what happens here. We put it into bins. Every 12-month return goes into one of these bins here. And so you can see how the GEM portfolio has a longer right tail and a much shorter left tail being losses and right tail being gains. And when you overlay one on the other, you can see that you've truncated away the larger losses, and you've extended the gains that go off to the right.
Yeah. I mean, the data tells you all you need. And I guess a incredibly disciplined advisor, should they choose to go down this path and just follow the rules, it gets rid of the decision-making process. You're able to eliminate the idea that you need to take somebody's guess or their prediction on where the market is going, and you're turning it over to data and price. Is that fair?
I'd say that's one of the main advantages to any quantitative, systematic, rules-based approach. You take a lot of the guesswork out of it. You just follow the model. And if you have clients who are questioning you, you just say, well, we're following the model. And once they understand the process and have some confidence in it, it makes life much easier for you.
Yeah. So we have a question from a viewer on Twitter. They want to know what you think about this model in today's market. With the Fed printing unlimited money, should any changes be made?
Well, I get emails all the time whenever something that appears extraordinary happens, saying, well, should we make some change here or some change there, or is the model obsolete? Well, that's always been going on. If you look back over any 20-year period, there's always these unusual circumstances. And that's why it's important to look at things over as long a period as possible. I've taken the GEM model back to 1950. I think the post-World War II era is pretty representative of pretty much everything. What we're going through right now, of course, is pretty extreme, but there have been other extremes over the past 50 years as well. And I don't have any trouble following the model. I think what it does is it takes a lot of the emotion away from things, a lot of the second guessing. For example, last month I was getting the most emails when the market was down 30%. But it made sense to just follow the model instead.
Yeah. That's the beauty of turning it all over to prices and rules, right?
That's correct.
Yeah.
Once you understand and have confidence in it and can see it going back as far as you can possibly go, then there's no reason to deviate from it unless you come up with some kind of improvement to it. And I do have some proprietary models that I license to advisors that take it to a little different level. But the basic idea is anyone can apply it. It's right in my book. I give a how-to instructions on how to implement dual momentum that anyone can use.
Yeah. So I want to make sure that listeners caught that. If you want to run the GEM portfolio, simply go to optimalmomentum.com, pick up a copy of Dual Momentum Investing, and he walks you through step by step how to do it. And you can see the historical results on the website. So you also offer these enhanced models for financial advisors. Uh, A, where can they find out more information about it? And B, but what would they get in terms of a deliverable should they sign up for your subscription service?
Well, it's not a subscription service. It's a licensing agreement. But
Got it.
what they get the signals from my proprietary models. I have an aggressive one similar to the GEM model here, but it's enhanced and it has a few different look back periods. It has dual momentum applied to the bond market. It has a way of scaling in and out uh, and some additional assets that are added. And then I have a global balance momentum, which is similar to a 60-40 stock bond balance model, in which there's always a permanent portion of the portfolio devoted to fixed income. And then I have a really conservative global conservative momentum model, which goes further in the towards the fixed income side of things. So what they get is the model signals. Uh, they get me as a consultant to go with it, and they get updates that I send out by email regularly to educate them and information they could pass along to their clients if they so choose.
Excellent. And can they find out more information about that at optimalmomentum.com?
There's mention of it there. They can just shoot me an email through the website, and I'd be happy to send them a fact sheet on what I do.
Okay. Excellent. Well, Gary, I really do appreciate you coming on. I encourage everybody who's interested in doing a deeper dive on this to pick up a copy of Dual Momentum Investing. It has changed the way I look at the investing landscape. Gary, thanks so much for coming on.
Thank you, Jay. It was a pleasure.